Hello and welcome. This is Roy. This time I'm sharing with you a clip taken from 80 minutes video, very comprehensive video that I've just finished to record for my subscribers. The video will help you whichever target you have in mind, whether you want to trade the hourly, intraday, or whether you want to trade on a daily basis or on a weekly basis. The video can help you map out your strategy for the week, for the month and beyond. You will see how I connect all the correlations that I find between various markets that amplifies the message that I have, amplifies the clarity of the trend that I see evolving. You can learn a lot more if you just give a try to my service. You can take a 1 week trial, and you can pay with PayPal or Money Bookers or Payza. My website is right here, and you can spend a bit of time going through some of the sections that I've got here. Don't hesitate to get in touch with me if you have any question. Other than that, I wish you have pleasant viewing and have a good week and good trading. Bye now. Hello and welcome. This is Roy. In this video I have many interesting charts, and here's the list. I've got the dollar index, the euro US dollar, the Australian dollar US dollar, New Zealand dollar US dollar, British pound US dollar, TYX, TNX, USD bond, TLT, gold, silver, light crude, Brent crude. We'll have a look at the chart of the level of margins in relationship to the GDP, which will serve the introduction to a whole string of stock markets charts that we have here. The Dow Transportation Average, the Dow, the S&P 500, the Nasdaq, the DAX, the FTSE of the UK, the RTS of Russia, a Brazilian ETF, the Hang Seng, the Chinese Securities Index, the STR of Singapore, the Nikkei of Japan, and I'll terminate the video with a look at the junk bond ETF traded in the US markets. I said I'm going to show a chart, so wait a minute. I don't want to forget that. Yes, there was a very interesting commentary by a guy that I don't know. I haven't heard of him, but he apparently not completely unknown. His name is Floyd Norris. He's in the US. Floyd Norris is the chief financial correspondent of the New York Times and writes a weekly column for the financial section. Okay, that's about him, and that's what he wrote. He says, is the US market heading for a fall? That appeared on the 2nd of June. 2nd of June, but I've seen the chart only during this week. I've seen a chart that is associated with this article that I thought I'll share with you. And here's what he says, and it's really interesting because he says US investors have taken out more margin loans than ever before. That indicates that speculative investing has grown among retail investors, reaching levels that in the past indicated the market was getting to unsustainable levels and might be in for a fall. The amount owned on loans secured by investments rose to 384 billion at the end of April. According to the data compiled by the Financial Industry Regulatory Authority, it was the first time the total had surpassed the 2007 peak of 381 billion, a peak that was followed by the Great Recession and credit crisis. Now, he keeps going here, and he says the latest total of borrowing amounts to 2.4% GDP. So we retain this number. You will see exactly why it's important. And then he goes on. I won't read the whole thing. And let's have a look at the chart. Here's the chart. That's him again. Yes. And he's talking about speculative investing has grown among retail investors, reaching levels that in the past indicated the market was getting to unsustainable levels. It might be in for a fall. And that's his chart. Margin debt as percentage of GDP. Now, this is really interesting. Do you see that's 2000? Do you see the peak? We were just under 3. We're now at 2.4, or at least at the end of April, we were at 2.4. Maybe it notched up a bit in May. And if we notched up, that's 2.25. So we could be around here, and we began to go down. That is 2007. Do you see? So to come and ignore this chart completely would be really, really stupid. That's my opinion, because um, there is something that is very important when you deal with margins. And if you ever traded on margin, you will immediately understand what I want to say. Uh, Leverage works both ways. Yes, if you deal with cash, you are with your feet on the ground in a much better situation when the market goes against you. But if you deal with margins, uh, the rate of the acceleration against you would look absolutely mind-boggling. It's if you get a chance at all, if the broker will get a chance to phone you or to alert you. Sometimes you don't even get that privilege. The margins can kill you very, very quickly. And what I'm saying is that here, when he says that a lot of people are basically on margin, it's extremely bad, because that means that once the bull gets rolling on the downside, the waves of margin calls is indeed creating this kind of wipeout killer wave. That happens because you have a lot of people on margin. If you studied the stock market behavior over many years, I haven't done an extremely detailed study, but I have done quite a bit of study. Whenever you had these mega falls, it is always associated with abuse of margin. And in New York, they have attempted to fight this with regulations, etc., etc. They had the problems also in the 1920s. They have attempted to, if you like, uh, put obstacles in the way of investors to go through, go wild like that, just in order to increase stability. And now we have run into obviously unsustainable levels, and it is quite possible that if the bull now began rolling on the downside, there'll be no stopping it so quickly. It will go to 2008 bottom. That shouldn't shock you. Okay, this is extremely important chart. Now here's the JNK. That's the Barclays High Yield Junk Bond chart. I presented it before and I said we have a screaming sell signal here from the MACD. That's the monthly going back to 2008. That's the bottom. That's an A. That's a B. That's a recovery, and the recovery ran out of steam pretty clearly. Run out of steam. This market has been trading water here for almost 8 months, and now it's beginning to move. It's beginning to move. I think we are probably seeing the first leg of something that will go a lot lower. How far? I'm not sure. I'm not sure. It's very tempting to say it's going there. Yes, and that could indeed be the case. But the banking sector in the U.S. is not as in a bad shape that it used to be in 2007. They have quite a lot of banks have made good progress and improved their ratios, etc. Didn't give any money, too many loans this time, but they're still vulnerable. The junk bonds are obviously very vulnerable if rates begin to rise, but I somehow don't know if they're going to that level, panic level. On economic ground doesn't look to me justified, but who am I to say to Mr. Market what to do? So right now I think this downtrend is on its way. I would imagine 34, 32 as a realistic target. Let's have a look at the weekly. You see the divergence is also here. No question, the divergence is prevalent. And short term, sorry, I'll just highlight the weekly here, and you can see the very massive break we got this week. Massive break, no question, should leave you no doubt where it wants to go. But I'll examine the daily from close. I know there is at least one member who is interested in this one. I think he's got already a position that is showing some nice profit, so all the better. That is the daily, with this being 1, 2, that's 3, that's 4, that's 5. That would say the first leg ended here. Okay, I hope it's pretty clear. It's actually resembling the pattern that we have discussed in the case of the bonds. Yes, and the bonds, the TLT. But be sensitive to this possibility that that could be 1 or 1 ending here, and in fact this is the first leg of the third. Okay, the first leg of the third. Now, how should you play that? Well, I would imagine that this, a rally above this should not occur. Yes, if you can afford a stop loss above this level, a rally should above this level 40-60 should not occur. We shouldn't see a close above this level. Given the break and given the struggle to climb before it broke, this should not occur. We shouldn't see a close above 40-60. If you are not sure, you want to just take your profits, walk away, fine. You'll get another chance. You get a great chance in case this is 1. Then look what will happen. If this is 1, of course you get a great chance. It'll come back here, and then you sell it again here. If that doesn't happen, in fact I'm wrong, and this is 1, how are you going to get another chance? Well, let me show you. It's all idealized scenario, yeah? We cannot be certain. But suppose this is 1 too, then the deterioration will continue straight away. And a tiny triangle here. Also in the bonds. The tiny triangle in the USD bond. A triangle in the rates. Yes, low-key zone, limited zone price action should tell you that this is the right wave count. 1, 2, 1, 2, and down we go in the months to come, and you will see 37 in the next month or 2. Yes, quite possible. Okay, so that's all for this video. Hope you find it useful. Wishing you successful trading. Bye now.